Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting. Welcome to Charts and Chat for November 20th of 2023. Well, hello, everybody. Hope you had a great week as we enter the week of Thanksgiving. Hope you are safe if you happen to be traveling this week to go see family, and hope those of you who are going to be with family that you enjoy that time. As we get started this week, let's turn our attention to some of the economic data that we had released over the last week. Maybe some things to kind of look forward to as we transition into December and then finally reach the end of the year in 2023. First, we have retail sales on the left-hand side. We've got this data, which shows us from February 2020. Here we've got nominal retail sales moving higher. But when you adjust those for inflation, they've actually been fairly flat for a long period of time. And we see perhaps maybe a little bit of an uptick here, but then over on the right-hand side, we've got a 12-month change in several of these categories. And you can see, in most cases, they're trending down. And so, and we have seen that kind of play out really since the beginning of the year here. On this chart, we have kind of a breakdown of retail and food service sales on a 1-month basis. So again, very microcosmic view here. And you can see, very clearly that we've got furniture, department stores, autos, really all in decline here. And where we're seeing a little bit of strength is in restaurant and bars, kind of the experiential spending here. We've got electronics and appliances as well. And then obviously grocery and drugstores. Here we have some industrial production data that shows some interesting trends, and then we can follow this up with some regional Fed survey data that we got over the last week. But here very clearly we can see industrial production, in a decline here. This is a monthly data series. Obviously the survey, the consensus expectation looking for a decline, but we got a slightly larger decline depicted here in red. And then this is industrial production month over month. Here we've got, over here we've got manufacturing production on a trend line basis. And then we've got capacity utilization. You can see that that trend line, after having recovered from the pandemic, we're kind of at a longer term trend line, but the latest readings are looking down. And for in some respect, capacity utilization also trending down. And the implications of this are very clearly that we've had a pullback in capital spending expectations. And, and that's where you see more leverage being taken on the balance sheet for companies to fund these capital improvement projects. But if your capacity utilization is going down, you're less incentivized to want to do that. Here we have some Empire State data. This is from the New York Fed. You can see here from a manufacturing standpoint, a little bit of an uptick, which, we'll take as a positive. However, if we look over here at expected new orders, we've got a decided downtick here over the last couple of months, as well as expected CapEx, which is what I was alluding to in that prior slide. And you can see that's been an evolving trend line. I think, there's other things at bay here. One is the access to capital. Banks are getting tighter. Number two is the rate of interest has gone up, and so the cost of that capital has gone higher as well. And so that tends to put a little bit of a dampening effect on the enthusiasm of companies to want to spend, especially if we're heading into an uncertain period where I think very clearly the consensus is looking for slower overall economic growth next year, kind of on the order of maybe about 1.5% versus, clearly the 2.5% or so that we're looking for this year. On this slide, we have New York Fed data here. We've got expected wages right here, and you can see wages, interestingly enough, moving higher. Now, we do see employment cost index beginning to tail over on a national basis, but at least in the New York Fed survey region here, you've got wages moving higher. And also another interesting development here is that you've got expected prices received also moving higher. On this slide, we have the Philly Fed data. And so the manufacturing index here looks a little bit like the Empire State, although still a little bit in decline. So anything below zero represents a contraction. So, but we're less negative than we were. And so that has improved, but we're still negative here. And then, so that's the Philadelphia Fed. And then we have the Kansas City Fed data that we also got last week, really kind of telling you the same story. Below the flat line here, but maybe a little bit better than we've seen. We're going to dig a little bit more into the Kansas City Fed. Here we've got new orders, which, again, kind of almost in opposition to the Empire State. We're actually seeing a little bit of an uptick in new orders, and as well as expected new orders. And so I guess the takeaway really from this is that you take all of these regional Fed surveys as a composite. Now, there have been times, certainly over the last year, where we've seen all of these kind of move in the same direction. But I think what we're seeing here with Kansas City versus Empire State is indicative of some differences in geography. There's clearly some dislocation here in these regions related to the auto sector, much more so, in the Chicago region, which is going to be much more impacted by General Motors and some of the other auto manufacturers. But on a regional basis, there are puts and takes, and in this case, in Kansas City, in the Kansas City Fed region, there is a little bit of room for optimism. Now we'll look at the ISM Manufacturing PMI. And so just to remind everybody, that's the Institute for Supply Management, Purchasing Managers Index for manufacturing. And this chart from Charlie Bolello clearly shows us with these recessionary periods kind of overlaid here that, on a diffusion index, we're currently below the flat line. So we're in contraction, and we're actually have been in contraction for 12 straight months. And you can see, when you have these periods, it tends to correlate with recession. And so that's not terribly surprising to us. But it is something that, again, we struggle with right now as an economy, as a market, as a sentiment. You see a lot of the investment banks reducing their expectations for a recession. Probabilities going down to like 10, 15%. Although I think if you talk to business owners and CEOs, their expectations for a more material slowdown are a little bit higher. But in any case, another data point here that seems to corroborate very well with, at a minimum, a recognizable economic downturn. And I think that the groundwork is already being laid. We can see that in retail sales from a few charts ago. That's beginning to trend down. Consumer represents 2/3 to 70% of the total economy. Consumer slows down, everything else is going to slow down as well. Something else that we've been monitoring is the federal budget deficit, and we did get an agreement. Surprisingly, I'll have to admit, in our Congress I say in many respects just to kind of continue to kick that can down the road, but at least it's an interim deal that gets us through the first part of the holidays. It's not a full resolution by any stretch of the imagination, but I think as we go back to 1982 and use this as kind of a yardstick, and we were running deficits for a long time, and then here at the towards the very end of the Clinton administration, ran a surplus, and then Bush, Obama, et cetera. And so here's where we are now. And so this is really the real bugaboo. And where is the spending going to go? And, like them or hate them, and I'm not waxing politic here, but there are people in Congress that are really spooked by this, that, that this is a big problem for them. But their answer to it is just kind of like choke off everything. And you can't do that. These things don't work on rocker switches. You have to evolve it over time to hopefully get back up to the break even. But, this is going to be an issue because we have to finance that, and we finance that with increased Treasury issuance, and we've got some other data related to that coming up that is something that we're going to have to reconcile and come to terms with. And this is probably unsustainable. Again, when you talk about all those years where we ran budget deficits back in the 80s, to try to combat communism, if you will, bring down the Iron Curtain, people were belly aching quite a bit over this type of a deficit. And, now we're here, and we, in some cases, kind of don't bat an eye, but we should. And so this is something that has implications for slower potential growth in the decades to come. But just want to bring it to your attention now. These two slides kind of dovetail off the last one. We've got with deficit spending comes an increase in government spending. This is a fairly long dated data series here, and sometimes B of A brings us some pretty interesting things. Now, this is a long trend line, so I think you can almost like chop this right here when you get to the global, well, before the global financial crisis, you get to the tech bubble and kind of look at where we are in this trend line of where we're going. And so, you've got economic growth that is moving in tandem with this. And again, this is government expenditures as a percent of GDP. So the government is clearly becoming a greater percentage of overall spending. And of course, this is not just not just defense spending. This is all of it. And so with that comes increased deficit spending, which is what we were talking about in that last slide. You can see here, going back to 1968, that these deviations are in a controlled and kind of like oscillating factor, or oscillating way, I should say. But then this is clearly an aberration, again, to the largesse of this deficit spending currently. And as a result, we are spending more on interest payments. We've got interest rates moving higher. And so, you think about, where we've been, like maybe over the last decade, global financial crisis here, you get to kind of the pre-pandemic period here, and that was like between 400 and 600 billion. And so we basically have doubled that now. And so spending on interest on the government debt is over $1 trillion. And this has the potential to, again, with the thought that you're going to have more Treasury issuance to finance these deficits, and we're going to have to finance those at higher rates. And so you've got this number which is going to move higher. And again, this is a pretty pronounced jump when you consider this long-term trend line dating back to World War II. But if this number continues to move higher, we already know that the discretionary part of the federal budget is fairly tight. And so this will serve to crowd out other government spending, which, as we just saw, has been very important and influential to overall economic growth. This is a very interesting slide. Now, this is a slide on gold purchases by central banks. And, again, this is kind of a global phenomenon. But we talk about gold as an asset, as a hedge, and I get a lot of questions about gold. We own it in the portfolios, and it serves as kind of a hedge when you have inflation and you get equity market volatility. And at various points, gold has been an awesome hedge. At other times, not so much. This is kind of interesting. So in a multi-year period here, we've got some fairly profound purchases of gold. Again, these are by central banks. This is on an annual basis in terms of metric tons. And you can see the trend line here has been in a fairly a reasonable band, but then we've had this breakout, almost a doubling of those levels. And so this has implications on the price of gold, obviously, and we feel like there's probably some staying power here. We talked about this a lot last week and over the last month or so is a contraction in bank lending. You can see that very clearly defined here. I think we showed you this chart, literally almost the same chart like a couple weeks ago. But this will preface some things that we'll talk about with regard to business sentiment and so on and so forth. But clearly, credit is getting tighter across the board. This is a national number, and we see it in the senior loan officer surveys, and we see it in a lot of areas, particularly in small business, which ultimately is the big driver of this economy. As a result of tighter lending from conventional banks, we do see the non-bank sector really evolving. And we did a few slides on private credit a few weeks ago. I thought this was really interesting, and so you can see the evolution over many years in private credit. There are a lot of kind of terms that are maybe opaque to a lot of people when you talk about mezzanine financing or distressed or venture debt, real estate debt, infrastructure debt. It's not a surprise here that like literally over the last 5 years or so, we've seen kind of an acceleration here. And this is something that confounds the Fed a little bit because it's a little bit harder to track. Now, this is obviously data that's been tracked here and it's voluntarily provided by these funds. But in a lot of cases, they're not required to adhere to the same reporting standards as would be the FDIC reports on the part of commercial banks. But in any case, you can see a pretty stout breakout in private credit and in particular in this black zone here, which is direct lending. So this would just be essentially non-bank banking here, and you can see that number's really broken out in 2021. We don't have the 22 data just quite yet, but we know that trend is likely to continue to accelerate and have that number be up here. So here's a chart comparing performance. This is kind of looking at it not through the lens of the economic benefit, but rather the investment opportunity in private credit. And you can see here that internal rates of return, which is what IRR stands for, we're getting good returns out of this. When you look at, public loans and high yield private market equity here, we're getting good yields over a longer period of time out of private credit. Now, these are not your, necessarily your blue chip borrowers out here, but they do represent a class that is on balance likely to, repay their loan. And, even though you absorb some defaults in adverse economic times, you're still able to achieve these outsized returns because of the portfolio management within, within those funds. Here we have business outlook diffusion. This is tied directly to shipments. So this is basically a survey of shipments on the part of small business. And you can see that has become a little bit weaker noticeably over the last year. Very consistent with what we've really been talking about, what we've been expecting. These red little bars here represent recessions. And so we are moving into an area that kind of puts us in strike zone of what would normally, kind of a recessionary type indication. But again, we see this in other areas. We just haven't seen the recession yet. And, and we may not. This is an oddity created out of this dislocation from the pandemic where we had all the stimulus payments and then now we've got negative money supply growth. But I think it's important to reflect on what business sees in their environment. And clearly from a shipment standpoint, it's moving the negative route right now. This is a reflection of the NFIB, National Federation of Independent Business, which is kind of the the trade group that represents small business here, and this is their view of expected credit conditions. So we talked about and showed you the chart of overall bank lending moving down. We showed you the chart of the banking sector picking up. And this is where small business feels like things are right now. Now, interestingly enough, you could barely see it, but we did have a little bit of an uptick here. And you can see that, when credit conditions are good, then you have this environment up here. When they're bad, they get down here. This is the global financial crisis. So obviously credit conditions were not favorable back then. And then we've had this consistent uptick. And then now we've rolled over. Like ever since this pandemic here, we've had a little bit of a flat line and then it's rolled over. And so conditions have increasingly become tight and seem to be holding in this area here. This is a chart of pricing versus really what a survey of what small business feels is their biggest problem. And so some of this data we get from Liz Ann Saunders, her team does a great job of synthesizing these data series for us and really picking out the things that we should be focusing on. And so here in the blue line here, we've got the evidence of higher prices. And so we know prices, went higher. They've come off their peak. They seem to be tail hooking here as of late. And so we've got a little bit of an uptick in prices. But just looking at retail sales coming down, I wanted to show this because it had small business, survey respondents saying that poor sales were their single most important problem. Well, that's kind of flatline, maybe slightly upticked over here, but again, it's still a problem. It maybe hasn't become acute yet because consumers still continue to spend, but clearly, I think poor sales, at least from a sentiment side, is still where it was several months ago. But higher prices are still something that we're seeing out there in the small business community. Well, continuing this theme, looking at small business, we want to pay attention to wages. Wages are obviously a very important part of the profit and loss schedule for any business, particularly service businesses. And we look at average hourly earnings as a major input into inflation. And so we know it's been higher. We can see here very clearly that it's coming down. Maybe a little bit slower than people have wanted it to. This dotted line represents the average from 2019, so we're not quite there yet, but it is moving the same way. Now, we've talked a lot about the labor markets and the quit rates and how salaries and wages have been higher, kind of up at this peak because of the amount of turnover that we saw in the labor market, which was, frankly, back here in this time was pretty robust. And so, we see a little bit more of a normalization in the overall labor market. We talk about overall employment, and here we see wages kind of dovetailing with that. So this is a disinflationary sign that is helpful, but again, it's still above trend. Couple of charts here on builder sentiment. We've got home builder sentiment that has kind of been back and forth, but is on a down leg as of late, and we can see expected single family sales within that survey also moving down. So this reflects in part, borrowing rates, which ironically have actually come down in the last few weeks because 10-year yields, treasury yields have come down. But it reflects kind of an interesting environment. So new home sales, which have been relatively strong, and sentiment obviously has been a little bit higher at various points this year, but it reflects just a challenging environment overall in housing. We have a chart here that kind of illustrates a lot of this conversation that I've had with a lot of people about this rent versus buy deal. And so, here's a monthly cost to buy a house. And so this is looking at it from really more of a cash flow situation. You can see green represent rents. You can see that that has escalated and probably has accelerated, catching up to home prices. And you can still see that the dislocation between rent versus buy is still is pretty profound, right? I mean, we haven't seen a gap like this in a long time. I mean, we had a price inflation heading into the global financial crisis. We had price inflation, back in before interest rates really started to move higher, and so that narrowed over time. And typically it oscillates around this, around the green line, which is the average monthly apartment rent. But right now we're at a stratospheric level in terms of overall home prices, and it's really skewed that rent versus buy decision. Now, what's important with the Consumer Price Index, the CPI, is owner's equivalent rent, which is what we're looking at here. And so there's a fairly boring, kind of mostly linear progression. And down here we have the annualized percent change. And so we know that OER, as it's affectionately known as, is still pretty high. So this is one of the stickiest components of inflation. And so, there's measures that take out housing, which we have in this chart pack. But if you just look at OER, which on balance is like 30%-ish of the overall CPI, and if you take core prices, it's even higher than that. On this chart, we have the basically that CPI, the core services less housing, and so this is what a lot of people affectionately known as the supercore. And so it's trying to strip out the most potentially volatile components of the overall inflation data. And you can see here that as you look at 22, that was a high inflation year. 23 has had its peaks and valleys here, but where we are now is, on the downslope. If you look at kind of a multi-year trend, it's clearly on a downslope, and something that should continue to be disinflationary, or represent disinflation as we meander closer to the Fed's 2% target. Here we have consumer prices on a 12-month change for various categories. You can see here the overall inflation trend looks favorable. That's something that we've been expecting and monitoring and talking about a lot, and it's broken out into these various groups. We've seen a little bit bolder negative change or disinflationary change with regard to toys and furniture, bedding, et cetera, but the whole basket seems to be moving down. Quick note on the global backdrop that this is not a U.S. phenomenon. We do see a little bit of weakness in the Eurozone just in terms of overall economic activity, particularly in the UK that's had a lot of inflation. Their inflation was a little bit stickier than ours, but you can see here very clearly the peak in inflation, and then it's coming down in kind of a more synchronized global way. Again, if the U.S. is going into an economic slowdown next year, I mean, the world is likely to follow. But after that, you're going to have more opportunities for investment when you hit that new economic cycle. But just know that sometimes these different geographical areas work at lags to one another. But at this point, they're synchronized, at least with respect to inflation. Here's a University of Michigan survey. This is the one thing I want to point out that really kind of belies everything else is that very oddly, you've had this consistent downtrend in inflation expectations. And this is looking out over the next 5 to 10 years. And just in the most recent data points here, we've actually seen that tick up to about 3.2% as that long-term inflation rate, which is obviously above the 2% that the Fed wants it. But the expected inflation looking ahead has long been a lot higher than what actual inflation has been. And you can see 2018, 2019, that long-term inflation was like 2.5%. And it's just very interesting in light of some of these disinflationary proclivities that we're seeing this higher number here now. So how does that impact interest rates? We've got basically we have 4 rate reductions priced in next year. So as we look in, this is like basically market, implied Fed funds rate change in 2024. So this is looking out over the whole year as we sit here in November. And right now the market's expecting a full percentage point of rate declines. And you can see that kind of depicted in this chart. Basically the Federal Reserve is going to meet again on the 13th of December. There's a 100% chance that rates are going to continue to be right where they are and then not expected to move again in January at their meeting. Then there's a slight probability of rate decreases at the March meeting, and then you can see how that increases over the course of 2024, getting to what the market currently expects is a percentage point. Now, just a quick comment on that's what's priced into the market right now, and that has a lot to do with the fact that there's this thought that we've seen the last Fed rate hike because of some of these disinflationary trends, the fact that both consumer and producer prices were surprisingly below expectations. And so there's a lot of optimism built into this, but the caution is, whether in actuality we get something more like maybe 1 or 2 cuts instead of 4 cuts. And, that would be certainly a surprise to the market that we'll have to pay attention to. But if you get something different from what the market expects, you can tend to have a little bit of volatility. This is a chart on oil, and so in the blue line it represents basically your month forward price, and right now we know that we've seen a little bit of decline in the oil markets. I saw this in a post from Liz Ann Saunders at Charles Schwab, and her point on this was not the directionally the oil is going down, because we certainly know that because we're seeing more supply and we're seeing some demand expectation drops as we headed into this, the slower economic period. But, her point was rather that, we've seen kind of a 13 to 15% drop in oil from its interim peak, but that is extremely normal. That you see these percentage price swings on a pretty frequent basis. And so we shouldn't get all worked up over the cheapness of oil. It is helpful in overall disinflation, but it can oscillate and be a little bit noisy based on geopolitical tensions, which obviously we've got several in the world right now, so on and so forth. We're going to transition now into the investment markets. Something that continues to evolve, is this whole difference between the S&P 500, the market capitalization weighted index that is publicized, and then the equal weight index of basically, all but the top 5 companies in the index. And so you can see here that the performance differential is extremely wide. I mean, almost historically wide. You've got to go way back to 1998 to get to a differential where the S&P 500 was outperforming the equal weighted index by this much. And essentially what this is telling us is that the top 5 stocks, essentially, you can argue the Magnificent Seven or whatever, but there's really 5 stocks that are driving this outperformance, and it's almost at a historic level right now. This is a chart that you don't see a whole lot. Again, this is from Liz Ann Saunders, and basically it's called kind of the rule of 20. And so if you add inflation to the price to earnings ratio of the S&P 500, you know, getting to 20 is kind of a level associated with below which it's associated with the market essentially being cheap and being attractive. And you could see, at various points here, market was attractive, but it wasn't terribly unattractive when we headed into the global financial crisis. So, there is that, and then, then it was, relatively attractive, for, various points over the last decade, maybe less so during the 2017, 2018 timeframe. But where we are now, that the sum of the PE ratio and the inflation number is about 23.8, and about 20 of that is the price to earnings ratio in the market right now. Not terribly stretched, but not terribly attractive here either. So I mentioned this a few slides ago that we now have the top 5 stocks, 25% of the overall S&P 500. And so when you think about the, that performance dislocation between the overall S&P 500 and the equal weighted index, it's because of these top 5 stocks. And you can see how, this has been a fairly meteoric rise here in getting to that level. And we haven't seen that in quite some time. Now, looking at the broader market, we want to break it out into the overall market, which is in the light blue here, affectionately known as the aggregate S&P, as well as the equal weight. So, I mean, the difference here is that this is counting the influence of the 495 other stocks, other than those top 5 stocks, in a very egalitarian way. In fact, treating all 500 of them in an egalitarian way. And so the other 495 are much more impactful in terms of the data that you get from it. And so when you look at a longer term trend line, again, looking at averages since 1990, the overall market is about 16 times forward earnings. Right now, we're trading around 18 times. So you can look at it on its face and say, the market is trading about 18 times forward earnings, and that's above the long-term trend lines, which makes this, technically richly valued. And I think you'd be right in saying that. But if you look at the equal weight, and the average since 1990 is 14 times, currently that particular sub-index here is trading at 14 times. So the broad market is very much in line with its historical averages, even if the overall market from a capitalization weighted, again, counting the influence of those top 5 stocks, is a little bit overweight. These charts really reflect the sentiment that we've seen, and it's been honestly a fairly stark change over a fairly short period of time. It's funny what happens to sentiment when you feel like you're at the end of a rate tightening cycle, which is kind of what has evolved over the last couple of weeks. You can see that sentiment was relatively negative a short time ago, and it's turned wholesale positive. So we've got some very strong bullish readings out of the AAII, which is the American Association of Individual Investors. And so this is kind of the sentiment that's reflected in the retail market. You and I, not the institutional buyers, not the fund managers, but the retail buyers. And so they're pretty optimistic right now. And as a result, we've seen equity fund flows that have actually been pretty strong here as of late. And then correspondingly, kind of point at this, I mean, we've had foreign net purchases of treasury notes and bonds. We do know that China's curbing their interest in treasuries, and so there are implications of this. We also see, outflows from treasury funds. We've seen the first outflow since February 23. So, when you think about, that, that's a pretty interesting development. And I think this figure has some implications. You can see, a lot of foreign purchases of treasuries, over a multi-year period. but that is clearly decelerating right now. And we know that China is taking some off the table, and you think we're going to have to be issuing more debt. And if you have fewer net foreign purchasers, it's going to put a lot of pressure on domestic buyers to fulfill those auctions of those new treasuries. And if you have fewer buyers for more supply, that tends to suggest that your pricing is going to come at a deeper discount and correspondingly higher interest rates. So there you go again, that whole issue about government interest on the federal debt remaining high, for certainly higher for longer. And I think the overall interest rates remaining higher for longer is a distinct implication of this. Here we have kind of a more detail, if you will, on Treasury purchases. You can see China depicted in this color here, and you can see clearly, as I was describing in that last slide, China has reduced its transactions in treasuries, and we've seen private investors have to take a much greater percentage of the slack, because you could see here, at various points like 2021 into 2022, you had a lot of other central banks that were in buying treasuries. Part of it to help maintain more, as much as they could, parity with the US dollar, but there are a lot of reasons behind that, stabilize their payment system, so on and so forth. But the calculus has changed, and China is definitely not as big a part of that calculus as they used to be. So we're going to end on China. We've got some data that, this particular data coming out of the Wall Street Journal. This is from their National Bureau of Stats. Retail sales up 7.6%. You can see the oscillizing, I should say, if that's even a term, over a period of time, but it has taken a leg up, and so that might give you cause for optimism here. Industrial production still kind of at a slightly below 5% level. That's the good news. Here we have the less favorable news, and so we've got consumer spending. We see that weakening. We've got food and housing. China's housing market is in a real funk, and that's still negative right now. And so you've got the dynamic of domestic purchasing really slowing down right now. And as I said, the housing market in China is a real kind of a problem child, as their commercial sector is too. You can see that those trend lines are moving down. So net new home prices as well as existing home sales here, both trending in that direction. And then you also have loan demand, which comes at an interesting time, because the Chinese government has been doing everything they can to try to stimulate that, and it hasn't worked. And so you've got some real issues here. And here's your financial impulse. This is from BCA. They do a lot of great work on this stuff. And so, the credit supply and the credit demand is really taking a leg down. And so I think the implications are slower overall growth from China looking ahead over the next 12 months. Well, that's all we have this week. Hope you've enjoyed it. Have a great Thanksgiving, and we'll talk to you again soon. Take care. Bye.